Morning, everybody. Welcome to our webinar on the financial implications of becoming a partner, and specifically on managing your investments, tax and pension. We've been doing a series of these, and it's lovely to have so many people attending them. I think we seem to be building up a bit of a fan club on them, which is fantastic. And thank you also for suggesting topics for subsequent ones, which is always so welcome. My name's Claire Watkins. I head up the professional practices team at Buzzacott, and we look after mainly law firms and architects and surveyors and other professional practices. So I'm delighted that you're all joining us today. There are a few housekeeping issues to begin with. We're going to be recording this. We know that we've had a few people who've said that they can't make the actual webinar, so they'd love to see a recording of it. So that will become available to everybody as soon as it's over. Do please submit questions using the Q&A function. When we did this last time, we had quite a lot of questions and we couldn't get to them all. So apologies now if we don't manage to get to them all, but we will follow up separately with any that we haven't managed to cover. So let me introduce you to our team, our speakers today. So we have, first of all, we have Simbre Barnes, who is a qualified financial planner, and Simbre works in our FCA regulated Buzzacott financial planning team, which is authorised to provide advice on pensions, investments and financial protection products. Simbre has been with us for 5 years and advises on general investments, financial planning for the family and pension planning. Then we have Howard Leddingham, who is also a manager in the private client team. He's been with Buzzacott since 2016 and he's a chartered tax advisor. He looks after both the business and personal tax compliance for clients. And he often looks at tax planning for entrepreneurs and owner-managed businesses. But that's not just income tax planning, that's, you know, all sorts of tax, capital gains tax, inheritance tax and business tax planning for things like capital allowances if you've got a big IT spend coming up. And then we have Jessica Beer, who is, I suppose, a slight rarity in a way, because she's not only a chartered tax advisor, but she's also a qualified chartered accountant as well. And she looks after tax compliance and planning for professional practices and their associated partners, as well as property investors and landlords and sole practitioners. So I'll just set the scene, and you can see from the agenda the topics that we'll be covering. Really, this came about, again, all our topics come about because of things that have been suggested to us by our clients and people that we know. As professionals, and all of us, we tend to focus always on our clients, and sometimes our own personal finances can take a bit of a back seat. We see this quite regularly with partners who've become self-employed partners, so they've become fixed share partners or equity partners, and especially so among partners who've been partners for a while but are still quite a long way from retirement. And you sort of look ahead and think, well, I've got plenty of time to organise pensions and investments and things, so I don't need to concentrate on it now. So the idea of tax planning, pension planning, general wealth management can be parked on the I'll deal with this next month pile, and before you know it, several months have gone by and the 5th of April is approaching. And all of a sudden you start thinking about making pension contributions, taking out ISAs, selling investments to take advantage of any capital gains tax allowance and that sort of thing. So really what we're trying to do with this is to plant some ideas in your heads, if you aren't already considering them, of things that you might like to start thinking about now. Simple things like pension contributions, where when you become a self-employed partner, it all of a sudden becomes much more difficult because it's up to you to decide where you're going to put your pension money and how you're going to set it up, understanding how the tax relief works, how to deal with it on your tax return. So Simbre and Jess and Howard will be talking to you a little bit about that. Ultimately, this is a very broad topic because the idea of pensions, wealth management, tax planning is enormous, and we could go on for days, but we're really going to focus on partners that have been partners for a few years, still have a way to go before retirement, and are perhaps wanting to check that they're planning ahead sufficiently, and just giving some ideas for that. So we'll turn to Simbre first, who is our chartered financial planner. Simbre, when do you think, and it's a big question, but when do you think is the best time to start planning for your future?
Yeah, thanks, Claire. That's a really great question, and to be honest, is one that I think is really, really important because we have so many people who come to us looking for advice and whether they know specifically exactly what their objectives are, or whether they have a general idea and need a bit of a steer in the right direction. What we tend to do is we'll sort of quantify those objectives, and it might be, they might be looking to plan for school fees, or they might be looking to plan for care home fees, or maybe upsizing their home, whatever it is. We'll quantify it, and then we'll sit down with them, and they'll realise actually, things have gone a bit too far, and they really should have been planning for this a while ago. And I think in terms of doing things earlier, obviously, the earlier the better, but there's two real reasons why I think that's the case. First of all is the compounding of investment returns, because over time that makes a huge difference. And secondly, I think, is the use of your tax allowances. So if you're able to do things on an annual basis over a period of 20 odd years, and you're maximizing use of those tax allowances, you're really reducing the tax drag on your overall wealth. And it essentially, what it means is that it's going to cost you less in real terms, because you're going to have more investment growth and you're going to have saved on your tax. So what I've done here is put together a very sort of simple illustration of demonstrating, the benefit of preparing sooner rather than later. And this example is drawing on the objective of retirement, and that's simply because it's a key objective of most people. It's a huge life-changing event. You're going from a position where you're earning on a monthly basis, you've got income coming in and you can go out and you can earn that, to a position where you're completely reliant on what you've accumulated during your working life. And if that isn't enough to sustain you for the rest of your life, then that's going to be a bit of a problem. So this is drawing on the retirement objective, and it's basically just showing you the growth of a pension over a 20-year period. So we're saying that the individual at the start is a 40-year-old individual. They've got £100,000 in their pension, and the three different lines are showing you different rates of contribution. So the blue line is where no contributions are made at all, and at age 60 the individual has around 180,000 in their pension. Purple line is where they're contributing £10,000 a year, and with that they have around £457,000 at age 60. And the pink line is where they're contributing £40,000 every year, and that pension pot reaches 1.29 million at the age of 60. And those figures are all in real terms. We're using the same assumptions for investment returns, so it's a like-for-like comparison in that sense, and it just really shows you the impact of those contributions over time. So it's just trying to sort of drive that home, I suppose. And then I guess after that, what people would say to us is, well, that's all well and good, but what does that actually mean to me in terms of the income that I can generate from that? And it's a really crucial question and quite difficult to answer. And I mean, it depends on various things such as investment returns, the way that you access your pension, whether you're going to access it flexibly and leave it invested, or you're going to take an annuity. But to give everyone a rough idea, if we take the lowest value, so the £180,000 pension, assuming that's left invested at a reasonable level of risk, you might be able to take around £8,000 a year for the rest of your life. If you took an annuity, that's probably reducing it to around £3,500, really showing you the difference in sort of annuity rates at the current time. The middle pension, the £457,000 pension, you might be able to draw around £20,000 if you left that invested for the rest of your life, which I think a lot of people would find surprising, that for a pot that's, £457,000 sounds like a lot of money, but to be only able to draw £20,000 a year is quite low. Reducing that to an annuity rate, you're looking at around £8,900. So really showing you the impact there. And finally, the £1.29 million pension, you might be able to draw around £57,000 a year, and that reduces to around £25,000 for an annuity. So it just demonstrates, hopefully, the importance of making those contributions earlier and building up your pension pot to as large a size as you can.
Lovely, thanks, Simbre. I think probably the audience might be used to the fact that the slides move at a slightly slower pace to the voices. We've got behind the scenes my marketing colleagues, Chloe and Amy, who are managing all the slides, but sometimes they don't move across as quickly as the voices do, so just bear with us. Thanks for that, Simbray. It is quite alarming actually to see that even if you put in what seems like quite a chunk of money over a period of time, it's quite a modest return really. I know I have I have the privilege of being able to talk to Buzzacott Financial Planning whenever I want to, because they're just at the other end of the floor that I work on. And every year I go and see Simbray or Rachel, one of her colleagues, and say, can you have a look at my pension pot and tell me whether it's, am I on track? And basically the answer is no, you need to put more in, you need to put more in. So I've taken advantage of the catch up on pension many a time, which the speakers will cover in a little while. Simbray, again, it's all well and good contributing to your pension, but there are lots of different types of funds. And how do you manage the underlying investments, and how does this change over someone's lifetime? Because I know the attitude to risk can certainly change. And I think we think that we're putting money into a pension, but we perhaps don't consider where it's being invested.
Yeah, absolutely. I think, again, that's a really important point, because a lot of people, they might, be making the correct savings, they might be making the most of their allowances, but actually, if you don't understand what you're physically invested, what are the nuts and bolts of what's underneath that portfolio, you could be losing out. And it's really important to monitor these things over time to make sure that you are on track to meet your objectives. So when it comes to sort of investments and portfolios, the first port of call the thing that we look at is really the risk level that you're exposed to. It's really important to sort of set up a strategy right at the start so you're fully aware of how you're invested and what level of risk you are exposed to. Because obviously, I mean, most people are aware that the greater the level of risk that you take, you would expect to have higher returns over the long term. But of course, there's going to be a downside to that. So with higher risk is going to be increased volatility. There's going to be increased sort of ups and downs in the value of your portfolio. And when we see market downturns, the higher the level of risk, you're more likely to see a significant downturn. So it is really important to think about what level of risk is appropriate for you. I'd say the first port of call, there's kind of 4 areas that we look at when we talk about this with clients. I'd say the first thing is probably the most important, timescale, because if you've got a long period, if you've got a long time period to invest, you are more able to take a higher level of risk because you've got longer to ride out those ups and downs in markets. After that, we would look at someone's natural attitude to risk. So how do they naturally feel about risk? Are they going to be, kept up at night worrying about their investments, or are they more sort of relaxed about it because they know that over time it should recover? And just to provide sort of a general guide or a steer to this, I like to talk about maybe the pandemic as a recent example with clients. So as we all know, back in March, April last year, markets took a pretty severe hit following the outbreak of coronavirus, and we saw investments fall. So I'll give the example of a cautious to moderate risk investor, which is, the low to medium graph on this table. And that, I would say, is someone who's invested in a portfolio of maybe around 40% equity exposure, the rest in sort of diversifying assets, mainly cash and bonds, maybe a bit of property or alternatives. And that kind of portfolio would have fallen by around 15% in the pandemic. In contrast to that, a medium to high risk level, so the graphs on the left, which we would say is probably invested with around 80% equity exposure, so double the level of equity exposure, probably fell around 23% during the pandemic. But I think the key point to note is that both of those portfolios recovered to above, back to their pre-pandemic levels within a period of around 6 to 9 months. So as long as you've got the attitude that you can sit tight and you can hold on, and you've got the time scale, so you don't need access to those monies, you can take that level of risk. But as I said, so obviously over the longer term, you can see from these graphs that by taking that higher level of risk, you should over the longer term have a greater portfolio. So with the last example, where we were looking at that £1.29 million pension pot, if you had taken a low to medium risk level over that period, rather than the medium to high level, you might end up with a portfolio that in real terms, so taking inflation into account, is actually around £340,000 less than it might have been. So it hopefully this drives home the difference. It doesn't necessarily mean that you should take a higher level of risk, because that does depend on various different factors, but it shows you the impact that the risk that you're taking is going to have over the long term. So I think other than that, other than the natural attitude to risk and the timescale, we also consider capacity for loss, which is quite difficult to quantify, but it's essentially looking at how much an individual could afford to lose without it materially impacting their standard of living. So things that we look out for that would be someone's asset base, their income, their guaranteed income, and importantly, what they spend. So how much do they actually need to spend every month? And then the last thing we look at with risk is their need to take risk, and that comes back into the objectives. If you want to retire and you want to be able to spend £50,000 a year, what sum of money do you need to have at retirement in order to achieve that? And to get there, what level of risk do you need to take? So I think all of those points are really important. But going back to the tax point, the investments are important, but also the tax planning is important, because if you're not doing things in the most tax efficient way, then you're going to end up with a tax drag on your investments as well.
Thanks, Simbre. I'm just laughing to myself because I remember my first job at the fresh age of, 21, 22, fresh out of university. My dear old father said to me, right, you've got to put money into a pension, because I don't think the company had a pension in those days. It wasn't with Buzzacott. And so I said, oh, okay, if I really have to. So he said, well, you save up some money. And he said, I'll help you find a pension company to put that with. And then when you retire, hopefully there'll be a little pot of money there. So I saved up some money and I put it into this pension pot that he suggested for me. He's not a pension planner. He just was very savvy with these kind of things and realized if I didn't put money into a pension, I'd only spend it. So and then the forms came through from the pension company, and I suppose I was about 22, and I filled in these forms and it said, what age do you want to retire? And at the age of 22, I thought, well, that's a good question. What age do I want to retire? I thought, well, 50 sounds about right, doesn't it? I'll be bored with working by 50. So I ticked the box for 50. And I don't think I've ever changed it. I've never put any more money in that pension, so I don't suppose it really matters. But I'm staring down the barrel of the big 50 very soon. And I know for sure I won't be able to retire. So Simbre, maybe I need you to speak to that pension company and just shift the date back a little bit. As you said, tax planning is hugely important. We're going to turn to my tax colleague Howard now. When partners are thinking of putting money into pensions, Howard, they are a very tax efficient way of saving while you're working or saving on tax. Can you just give us some insight as to how much can be contributed from a tax perspective?
Yeah. Thanks, Claire. This is obviously a very important point, especially as Simbre has shown, when you consider how much you can contribute to your pension on an annual basis and the difference that makes to the sort of the end pot that you've got, and especially when that shows how much you can actually take out at the end when you retire. But it's also a really important point, as there's been some changes to the amount individuals can contribute into their pension in recent years. So really keeping on top of obviously the changes is key. So the starting point for pensions that we would always consider is the initial calculation, where you compare an individual's relevant earnings to the annual allowance of £40,000. Now, an individual can contribute each year the lower of those two amounts. So if an individual's relevant earnings is below 40,000, it will be the relevant earnings, and obviously the other way around if it is above. So the sort of things that we can consider in relevant earnings are things such as obviously employment income, your partnership profits, but also you can include things such as furnished holiday lets profits. Once you've then established whether you're obviously on the relevant earnings side or the £40,000, there's then a second calculation that we have to do, which considers people that are deemed to be high income. Now, from the 2020-21 tax year, this has been for individuals with net income of above £240,000, and their annual allowance is then reduced by £1 for every £2 that they go over this amount. So that's for some that will obviously seem quite a way off, but then for others not quite so much. But that prior to that point in 2020-21, those limits were back down to £150,000. So this gave obviously quite a big increase from 150 to 240,000 pounds for those that are deemed to be at high income overnight. And for some that obviously produced a big win because they were able to then contribute more, but for others that obviously could contribute less. So then after you've then looked at those limits, there's then a minimum the annual allowance can be reduced to. So from 2020-21, this could be reduced to £4,000. But prior to that, the minimum that it could be reduced to was £10,000. So there's kind of obviously two initial changes, one being the limits, and then two is the reduction of the minimum. So after then, you've obviously got your annual allowance for the current tax year that you're in. You can then utilise the three previous tax years, and they could be brought forward and added to the annual allowance for a certain year. So these are used on a first in, first out basis. So if, for example, we're considering the 2021 tax year, someone could then utilise the 17-18, 18-19 and 19-20 unused annual allowances after you've utilised the current year. So that's kind of the one key point about this is if you've obviously got, say, a £40,000 annual allowance for 2021, say, and you only contribute £30,000, you can't start using your unused brought forward amounts. You have to use the current year pot first. So in using that example again, if obviously someone had a £40,000 annual allowance for a current year and they contributed £50,000 to their pension in 2020-21, they would use 17-18's unused annual allowance before then moving on to those other years, 18-19 and 19-20. Once those obviously 3 years have then gone past, that annual allowance is lost. So obviously using that example, then if you don't obviously over contribute in your 2021 tax year, you don't utilise your 17-18 year, then that is lost forever and you would never be able to use that again. So obviously when individuals are going up across the ranks and or the partnership is earning a lot more money and their profits are going up, they might see that they become high income quite quickly, and that then reduces it quite heavily. And obviously now since 2021 there's been you can get your annual allowance reduced to £4,000. If that's happened quite quickly, you've been made equity partner, for example, and those profits are very high, you suddenly can't contribute very much in the current year. So utilising those brought forward allowances can be very important at that point in time. The kind of last point I'll touch on really is, I guess, specific for partners, and that's on occasion where certain firms will have an arrangement with the partners where they'll contribute a certain amount each year for all of the partners, kind of for them, and make the contributions to their pension pot, obviously through the firm. So when this sort of arrangement exists, whenever they make a contribution on behalf of a partner, those will be taken out of the individual's current account and kind of be deemed as additional drawings. Now, fundamentally, that's no different than them taking additional drawings themselves and then making the contribution themselves to their pension pot, or as if they did it out of personal income. So obviously the contribution will go in, and then the gross sort of basic rate tax will be also added to the contribution that they made. Now, this doesn't essentially stop partners being able to plan for themselves and contribute more if they see fit or utilise their brought forward allowances. So I think just the key point is when that sort of arrangement exists, understand fundamentally what's going on, and they're essentially making a contribution for you, and that doesn't stop you doing everything sort of independently on your own if you choose to.
Howard, thanks. Yes, that the last point we put in, because we do find that with salaried partners who have recently become self-employed partners, so they've moved from salaried partnership to fixed share partner or even straight to equity partner, we do find that sometimes there's a mismatch with the pension, and that because the firm can act as a facilitator to put the money into the pension scheme, it's sort of regarded by that partner as if it's an employer contribution, and it's not, because that partner has ceased to be an employee. So it is very important that where the pension contribution ends up in your LLP's accounts, in your partnership accounts, that's pulled out so that it's part of what you've paid into your own pension rather than what the firm has paid in. That makes sense. Jessica, let's turn to you, because although the main goal for pension savings is to provide for retirement. Can you talk us through the additional tax incentives available for pension contributions? Because when you see that calculation and you realise, if I pay this money into my pension, I save this much in tax, then although you're not going to end up with any more money in your own pocket, it really becomes a no-brainer, if you've got the money available in the first place, to put it into your pension rather than into the taxman's hands. Can you just talk us through how the tax relief works?
Should I mute myself before I start speaking? Thanks, Claire, and good morning, everyone. Thanks for joining us today. It's interesting to talk about the tax incentives that you would receive from your pension. It's kind of a follow-on from Howard's last comment and your last comment about how some partners get confused about employer contributions. The tax relief is another quite confusing aspect. So it might be quite common, like looking at the table below or on the slide, you can see that if you want £100 added to your pension, then that's a net cash cost to you of £55. So this can sometimes lead to a lot of confusion for partners, because they see a certain amount of money go out of their bank account, and then when we talk about tax relief, they're expecting money back in their pocket, which in reality isn't always the case. So to try and explain how the tax relief really works, I'm going to talk about it in the 3 different stages, and for ease of reference, I'm going to use a gross contribution into your pension of £100, and I'm going to be talking about it as if you were a higher rate taxpayer, so at the moment earning more than profits of over £150,000. So stage 1 of making a pension contribution would be the contribution that's physically being made by you as a partner or by the firm on your behalf. So it's the amount that essentially comes out of the bank account. So you can see there that when the contribution is made net, so you would make a physical contribution of £80. That £80 goes straight into your pension pot once it leaves your bank account. At this point, no tax relief has been received. So the second stage of contributing to your pension would be immediately once you have made that contribution, the government will contribute 20% into your pension pot also. So on a contribution of £80, they would add £20, which makes a total of £100 going into your pension pot. So that's the initial 20% tax relief that people talk about, or basic rate tax relief that people talk about when you're making pension contributions. The additional relief, or the additional or higher rate relief that you would receive then comes when you're preparing your tax return. So when you prepare your tax return, I won't talk you through all the nuts and bolts of it, but essentially it extends the amount that you can be charged to tax at your basic rate. So you're receiving tax relief at your highest marginal rate of tax relief on your tax return. If you're an additional rate taxpayer, that relief is a further 25%. So you're a 45% taxpayer, you've had 20% from the government, so there's an additional 25% that you can claim. That £25 worth of tax relief is given as a reduction to your final tax liability. It's not an amount of money that's going to be transferred back to you, but instead it reduces the amount you have to pay to HMRC on your taxable profits. So now most partners don't physically see that. However, especially when tax reserves are maintained by the firm on your behalf, you don't see the tax being paid to HMRC, but know that the firm hold the reserves on your behalf. They are still your funds, so it is still a cash saving to you. So then essentially that's why we're calling that's why we say that it's a net cash position of £55 outlay from you, but you get £100 worth of benefit in your total benefit in your pension. Understandably, that will grow over time, as Simbre talked about earlier. So that's essentially how the tax relief works on your contributions. I understand that that's quite a complex area to talk about, but hopefully that I've talked us around that little table enough. But if you do have any questions, just let us know. A couple of other things to note about pensions is that the growth within your pension, so the underlying investments, how they perform, the gains that you make, any income that's received, that's all received tax-free. Pensions can also, it's less commonly known, but pensions can also be considered free of inheritance tax, so they can be passed on your death to a spouse or a child or a grandchild, free of inheritance tax. I say it's less commonly known because in reality what happens is people draw down from their pension. They don't usually have it there on their death that's available to transfer. But just know, if you do have, if your other investments have done really well, you might not need to draw down from your pension, then it's free of IHT if you do want to transfer it in your will. When you reach retirement age, you can take 25% of your pension pot as a lump sum, tax-free. And then after that, any drawdowns will be taxed as pension income and included either on your tax return, or if you don't need to do one, via PAYE usually, or the equivalent for pensions. The final point I wanted to mention is Howard was talking about how much you can contribute to your pension. It is kind of connected to that, but I just want to make you aware of the lifetime allowance. It's just another limitation that they put on your pension savings. If the value of your pension pot, so not the contributions, not necessarily the value of your contributions, but if the value of your pension pot exceeds the lifetime limit, which at the moment is 1.073 million, then you can't really, you can't contribute any further tax efficient contributions into the pension. So it's just into your pension. So it's just worth bearing in mind. It's really important to notice or to note that the lifetime allowance has decreased over the years, quite gradually, but it could go down further. You can take out fixed protection to make sure that you're not taxed punitively if you do go over the limit, but just so you can see how much it's come down from, in 2012 the lifetime allowance was 1.8 million. It's been higher than that in previous years, but I didn't go back any further, and now it's 1.073. A couple of years ago they put it down to, I think, 1.055 million, and it's come back up slightly from there. So it's just make sure you have that in the back of your mind to think about in terms of your planning as well.
Lovely, thank you, Jess. Now, we talked a lot about pensions, but that's really because that's the thing that most clients are wanting to put their money into, or at least if they're also putting it into other areas as well, pensions is one of them. But what other types of tax efficient investment opportunities are there? Because we know there are a great many, and we have some clients who like to use every single available investment to put their money into. So what other ones do you see?
Oh, there are lots of other tax efficient ways of investing. I'll talk you through some of them now. It is quite important to realise that they exist, because although the pension, we talk about the pension the most because it gives you the biggest benefit. It's the best way of getting tax relief, but also having some enduring benefit for you sometime in the future. But there are lots of other different ways, and one of the most common ones that we talk about, we commonly see, is ISAs. So everything within an ISA can grow, and again in the same way as your pension, while it remains within the ISA wrapper, can grow tax-free, and any income that you would receive within an ISA is also tax-free. You can also draw down from your ISA, so take money out of your ISA tax-free, but it's important to know when you take it out, you can't just put it back in. There is a limit to how much you can invest within an ISA every year, and at the moment that's £20,000 for an adult individual. What I will say is, for husbands and wife, it provides quite a good planning opportunity because they can pass assets and money between the two of them tax-free. So you could set up an ISA for your wife or your husband, depending on who had the spare cash available at the time, and also for your children. So you can get junior ISAs, and up to £9,000 per year can go into those as well. So it just does provide a very tax efficient way of saving, but also if it's a cash ISA, it's much more liquid. You have easier access to the funds than you do with your pension, which you'd obviously have to wait until retirement to draw down from. National savings certificates are exempt from tax, so previously were quite popular, a popular investment or a way to invest your money. However, at the moment they're not open to new investments, but if you already held national savings certificates, they do let you roll those over into new ones if they reach their expiry, which they often do. Then there's general investment accounts. So the income and dividends or capital growth that you receive from a general investment account are taxable. However, they do provide a really good way of making the use of your annual allowances. So the annual dividend allowance at the moment is £2,000. The first £2,000 worth of dividends you receive are tax-free. And then there's also the savings allowance. So if you're a basic rate taxpayer, you get the first £1,000 of your interest income is tax-free, or tax at 0%, I should say, sorry. If you're a high rate taxpayer, then it's £500. If you are an additional rate taxpayer, you don't get a savings allowance. That's all I will say, but you do still get the dividend allowance, so could be quite useful to utilise. For these EIS and SEIS scheme, they are, I would say, more risky investments, but in saying that they are more risky investments, that's why there's a tax relief of 30% of the value of your investment, and that's a tax reduce that you get directly through your tax return or your self-assessment account. And the reason the tax relief is so high, I think, matches the risk or the increased risk on those investments, because they're usually startup companies. I'm sure Simbray will mention that or talk you through a bit more about the underlying investments with that a bit later. And then there's also venture capitalist trusts, so VCTs. Again, there's 30% tax relief on the value of your investments, and in addition to that, the dividends received on the first 100k of your investments are also considered to be tax-free, and in addition to your, or they might eat into your dividend allowance, but on top of your dividend allowance as well. So those are just a few of the more tax efficient ways that we can save or consider saving.
Lovely, thank you, Jess. We're getting a few questions in from the audience. When you do submit a question, if you could just put your name, because I think sometimes when people sign up, they don't always put their name, and if we don't manage to get to the question in this, then we know who to reply to after the webinar. We've had a question about VCTs. Can I turn to Simbray for this one? The question is, how risky are they from an investment perspective? Can you tell us a bit about them and other sorts of investments?
Yeah, absolutely, Claire. So very good point, because obviously, as we've touched on, the tax savings are really important, and what Jess talked through in terms of the tax relief, they seem really beneficial, a good investment, but it's really important that you understand the underlying investments and the nuts and bolts of what you're going into. So VCTs, venture capital trusts, I think the main thing to point out is that they should be considered a high risk investment, and that is because the underlying holdings, that the companies that you're investing in within that product, are unquoted or AIM quoted companies. So they're smaller companies, and they have to meet certain criteria in order to qualify as a VCT and to qualify for the tax relief. They have to be a relatively new company. So they, for most companies in VCTs, will have to be no older than 7 years since their first commercial sale. For knowledge intensive companies, it's 10 years. But I think the main thing is that they are new companies, and there is always an additional risk with such new companies, that the chances of them completely going bust in comparison to a big listed, maybe FTSE 100, FTSE 250, whatever company, the chances of them, not doing so well or going bust are a lot greater. And then secondly to that is the liquidity risk, and the liquidity risk is really because they are smaller companies. And whilst VCTs are listed on the London Stock Exchange, the secondary market for trading in them is pretty low. So they trade at a discount to the net asset value. So it can be harder to get your money out. And then last of all, you have to actually hold the VCT for a period of at least 5 years in order to retain that income tax relief that Jess was talking about, the 30%. So it is definitely a long-term investment, and you wouldn't be wanting to access that capital during that period. So I think those are probably the main points about VCTs. But what I would say is that whilst they are high risk, the tax relief is obviously a good incentive, and the other tax benefits that Jess mentioned, such as the tax-free dividends. It depends really on the individual and their overall situation as to whether they are a suitable investment for them. We tend to look at an individual's overall situation and, first of all, their appetite for risk, because if they have a high appetite for risk, then it might work, as well as, you know, having enough income to benefit from the tax relief. So they can make a good sort of satellite portfolio, as it were. But I would never say that they should be a core part of your savings. Your bread and butter really should be your pensions, your ISAs, perhaps a general investment account as well. And then VCTs might be a smaller portion. And normally we would say no more than 5% of someone's sort of overall wealth should be invested in those. And then in terms of the other sort of investments, I'll just briefly sort of touch on those. EIS, enterprise investment schemes, and the seed EIS investments, they're fairly similar in the sense that they are also investing in unquoted companies. They might come in a packaged solution which maybe invests in several different underlying companies, so you've got a bit of diversification there, and there are various companies that offer those types of products. Or you can get EIS relief directly on an investment into just one single company, as long as it meets the rules that makes it qualify for the tax relief. General investment account, as I mentioned briefly then, a GIA, it basically means just a taxable account. So you could invest in exactly the same way as you might be able to in an ISA. So you could have direct stocks and bonds, you could have different types of funds, property funds, multi-asset funds, whatever it might be, can be invested in a general investment account. But it's just quite a good way of using things like your dividend allowance, your capital gains tax allowance in that type of product. National savings certificates are really just a cash investment. As Jess mentioned, they're not currently out for people to purchase new ones. But if you've got them existing and they're linked, the return is linked to inflation, in comparison to a lot of cash accounts at the moment, that will be paying a lot more than what you'd get elsewhere. So often where people have those, we tend to say it's a good idea, unless you need the cash for something else, to roll that over and continue getting that sort of higher level of interest. And then ISAs, again, a stocks and shares ISA can be invested in numerous things, funds or equities, bonds. I might just quickly mention at this point the lifetime ISA, which was brought out a few years ago, and it's a specific type of ISA. You can only put in up to £4,000 a year, which uses up part of the £20,000 allowance. But it's quite good in the sense that you get a government bonus of 20%. So if you put in £4,000 in a tax year, the government would put an extra £1,000 into that for you. So you're getting that extra, effectively basic rate tax relief. But the conditions that come with that are that you have to either use the money within the LISA for purchasing your first home. It has to be a first home, or for retirement, which means, and the rules of the LISA are that you can access it after age 60. And all I would say is I would caution against using it if you didn't know that you were definitely going to use it for one of those two purposes, and that's because there is a heavy sort of penalty that removes all of the government bonus plus extra on drawing it out if you're not taking it for either of those two reasons. But if you know that you are going to use it for one of those, then I would say that it's a good idea. The only other thing to point out is that you have to be between the ages of 18 and 40 to be contributing to a LISA.
Oh, well, lovely. That rules me out. We've had questions coming through on a very similar topic, which we'll touch on quickly, and then we do just want to move on to something that we weren't even planning to include in this webinar, which is the HMRC consultation, which we'll come on to, but we have had questions about it, so we're going to try and squeeze it in. But first of all, we've had questions through about if you have excess savings and, for example, you have a large mortgage, is it a good idea to use the excess savings to pay off that mortgage? And actually, a similar way of looking at it, we're talking very much here about tax efficient ways of using funds, but of course investment decisions aren't always for tax purposes, and there are a lot of other things you can do with your money. So maybe back to Simbray, if you have surplus income, should you be investing it, or should you be paying it off your mortgage?
Thanks, Claire. Yeah, I mean, this is a question that we get asked a lot. For obvious reasons. I think there's a lot of people in that sort of situation. First of all, I'll point out that if you've got the option of investing and you've got the option of paying off your mortgage, paying off the mortgage is the least risky option, and that is because you're getting a certain outcome. You know that you're not going to be paying whatever level of interest it is that you're paying on that mortgage. Whereas investing is the risky option because you don't know what returns you're going to get over that period. And essentially, whether you're better off from investing or repaying your mortgage will come down to the investment returns that are achieved if you were to invest. So generally speaking, people with maybe a higher appetite for risk and might be investing at a higher risk level, probably more likely to be better off by investing. But I mean, not necessarily. And it also sort of depends on other things. So, for example, if you've got penalties on your mortgage, then that's going to obviously deduct from the overall attractiveness of that. And I think what you also have to think about is the wider economic environment that we find ourselves in, because as most people will know, that mortgage rates at the moment are really, really low, which means that you do stand more of a chance of being better off by investing. But you know, the question is that going to remain the case? There's been lots of talk about there has been increasing inflation over the last 6 months or so, and the question is, when are central banks going to have to raise interest rates? And whilst it doesn't look like maybe that's coming for another year or two, it is something that needs to be on people's radar, because once those interest rates start going up, it's going to get harder to get over that hurdle rate to make investing more attractive than paying off your mortgage. So I think in summary, it's a really hard question to answer, and when we talk to clients about it, we really have to take in everyone's personal situation and exactly what's going on in their life, as well as their overall risk appetite, in order to provide a thorough answer. Hopefully that provides some sort of context.
Yeah, it is a tough one. I always think you have to bear in mind how how difficult it would be to get another mortgage if you needed one. And I know we see with partners who've recently become self-employed that they don't have a track record of being self-employed partners. So from a lender's point of view, they get a bit twitchy about lending to somebody that isn't able to produce 3 years worth of pay slips, for example. So just bearing in mind how easily you can get another mortgage if you need to, I think is worth considering. Now we've got 9 minutes left. Howard, can we turn to you in a sec, because I want to throw quite a bit at you on this. I wondered whether you could just talk us through the tax planning, how to cash flow when it comes to preparing for your tax payments as a partner, but also whether you could just briefly, or as briefly as you can, touch on the HMRC consultation that came out just recently. For those of you who haven't heard about this is a consultation that may affect, or will affect, firms that have a year end other than 31st of March or 5th of April. So that's a lot of firms out there, partnerships and LLPs, that don't have a 5th of April or 31st of March year end. And it's probably going to mean that you will want to change your year end to the 31st of March, or I suppose to the 5th of April, but it's coming in quite imminently. So Howard, over to you. Do you want to, discuss?
Yeah, I'll try and keep obviously as brief as possible, because as you say, this is kind of a topic that we could probably have a webinar on it in itself. So if we look at the sort of current form of the legislation at the moment for partners, so you'll pay your tax kind of at 2 different dates, one being the 31st of January and the second one being the 31st of July, immediately ending at the end of the current tax year that you're in. So if we're looking at 21-22, it'll be the 31st of January 22 where you'll make your first payment on account, and then the 31st of July when you make your second payment on account. Now, if your profits or your reliefs have gone down, then you might have to make a top-up payment, which would be in the 31st of January following that. Now, for partners and anyone that's deemed to be self-employed, you're taxed on the year end that falls in that tax year. So if we use the example of 21-22 again, this will include all year ends of the business from the 30th of April 21 all the way around to the 31st of March 2022. Now, this can obviously create some sort of lag that from the tax payments that you make and the time you actually earn those profits. So especially for obviously the 30th of April year ends, you have to imagine that you'll be earning your profits to the 30th of April 2021, but you won't actually be making your tax payments till the 31st of January 2022. So really planning for that is going to be really key in those sort of situations, because we far often see partners that haven't considered that and haven't reserved obviously prudently for their tax liabilities when there's such a delay in making those tax payments. Obviously people have used 30th of April year ends for many years, and it's due to the sort of lag that you can get at the start, but obviously when you can come to retire, especially, that can catch up with you because of this delay that you have. So kind of obviously we know now that there can be a certain lag between the profits that you earn and the tax payments you make, but really how you reserve for this is going to be down to you in the end, and there's many different methods that you can use. So some people will reserve at a flat rate. So we see a lot of people that are kind of in the range of up to 100 to 150,000 pounds reserving at sort of a flat rate of 42%, which will normally cover all of the tax payments that they have to make. And then there's sort of some more complex methods. You can sort of work out marginal rates based on estimated profits. You can sort of look for the tax payments that obviously are related to the profits that you've earned and reserve that way. It really, in the end, doesn't matter as much as long as you've got enough in the end to make all of your tax payments up until you retire. So this is kind of obviously I've spoken about reserving, but I really just want to make sure that people are aware that even if the firm is reserving for you and on your behalf, that doesn't mean that there's somehow no responsibility for you to make those tax payments. If the reserves aren't there to make the tax payments, those will still be your responsibility with HMRC, and HMRC will still come for those tax payments from you. So it is really key, I guess, for people to kind of not suddenly think that, oh, well, the firm is reserving for me, so therefore I can sort of relinquish your responsibility for them. HMRC will still come knocking for their tax in the end of the day. So kind of when we then look at sort of obviously 30th of April year ends, as many of you will know, if you've kind of been at a firm that has a 30th of April or any other year ends other than the 31st of March, there's a period of overlap that is created when you first join as a partner. This is then carried forward, and then when you look to retire, that will then be taken off your final year profits, and that's known as your overlap relief. So that's used to then obviously reduce the taxable profits that when you retire from the kind of the period where you were taxed twice at the start. Now, this is obviously beneficial at this point in time, and could be very useful for partners, but kind of as you mentioned, Claire, obviously the HMRC consultation, which has come out in the last couple of months, kind of may bring an end to sort of 30th of April year ends, and certainly will bring an end to overlap relief. So the consultation, kind of as it stands at the moment, is going to take effect from the 2022-23 tax year, and this will mean that every partner or self-employed individual is taxed in line with the tax year. So from the 2022-23, if that runs from the 6th of April 2022 to the 5th of April 2023, all partners, no matter what their year end, will be taxed on that period of profits. So this obviously isn't enforcing that firms change their year ends at this point, and certainly the consultation doesn't suggest that yet. But if they don't, there will be not only the period of profits for the business year, but you will also have to estimate profits until the 31st of March or the 5th of April each year. So this is obviously going to cause certain complications. It will certainly cause complications for us as tax advisors, because every single year we'll be estimating profits, and then following year we'll have to then probably submit amended tax returns once obviously the partnership or the LLP return has been finalised. So 2022-23 could be obviously a very crucial year if this goes through, and certainly from what we've read, it's sort of in the industry, it looks like this is going to go through. So 2022-23 could be a really crucial year for partnerships, and I think we will see a lot of firms switch to having 31st of March year ends, and therefore kind of on a bigger scale scheme, looking away from sort of financial planning for partners. There'll be a big financial planning that needs to be done for firms, as this will obviously activate everyone's overlap relief at this point in time, as then it becomes abolished. So yeah, making sure we're ahead of the curve, especially for firms which don't have a 31st March year end, is crucial.
Howard, thank you. We weren't really planning on making this part of the webinar, but it is something that has come up, very recently. We've been getting lots of questions on it. So yeah, as Howard said, I think we've got about 30 seconds to go, but as Howard said, it is very important that you do talk to your tax advisors about how, if you do change your year end, by the way, you don't have to change your year end, but practically speaking, firms that are not already a 31st of March year end are probably going to want to, just to make things simple for themselves. You need to think about how it's going to affect each of your partners either way, and there are also various businessy type things that you need to consider. Will you change your VAT quarters to coincide with the new financial year end as well? So the whole team of us, we're doing quite a lot of work on this at the moment, because we have a number of clients that are not 31st of March year end. Buzzacott isn't either. We're a 30th of September year end, so we're battling with this ourselves as well. It's 10:30, so I will wrap this up. Thank you so much, everybody, for joining us. Thank you very much to our speakers and to Chloe and Amy in the background, who've been making everything work smoothly. Do give us ideas for other webinars. We love to hear them, and we're driven by what you want us to talk about. So hopefully we'll see you at the next one. Thank you.